Hello, everyone. So let us just first start this lesson with a brief concept, that is the net demand and time liability. We would be discussing about the NDTL first. So let us just consider that on 1st of January you deposited 500 rupees in the bank. Plus sign denotes that you are depositing and minus sign denotes that you are withdrawing the money. So on 2nd of Jan you withdrew 300 rupees and on 3rd of January you again deposited 100 rupees. So adding all these numbers, we would get the net demand and time liability to be rupees 300. That is 500 minus 300 plus 100 sums up to rupees 300. So the net demand and time liability is 300 here. Now, what is the meaning of demand and what is the meaning of time liability here? So whenever you deposit money in your current account or the saving account, then the money that you are depositing is known as the demand liability. Any money that is deposited in the bank is a liability on the bank, because ultimately bank would have to return that money to you along with the interest payment. So demand liability is basically that liability that is, you can withdraw money anytime depending upon your own demand. So demand liability is basically that liability in which the banks have to give you the money based on your demand. Whenever you would go to the demand, banks are liable to pay you the money. Whereas the opposite of demand liability is the time liability. Time liability basically means a fixed deposit reserve, which is also known as the FD. And suppose that you have an FD for 1 year, so you won't be able to withdraw money before 1 year. Okay, so that is basically a time liability, that this liability would accrue upon the banks only after 1 year and not before that. You cannot just go to the bank and withdraw money out of a FD because it is a time liability. Okay, so this is the concept of net demand and time liability. Now let us just understand different ratios that are important from the banking point of view. These ratios we would be using in the subsequent slides and also in the capital infusion part, and so I'm just covering from the basics so that every concept is just clear to you. So as far as the ratios are concerned, so the first ratio is the cash reserve ratio. Cash reserve ratio currently stands at 4%. And 4% of what? Basically, whenever RBI declares any ratio, be it the cash reserve ratio, be it the statutory liquidity ratio, it is percentage of NDTL, that is the net demand and time liability that we just calculated in the previous slide. So whenever the RBI says that CRR is 4%, it means 4% of NDTL, that is 4% of net demand and time liability. So here the cash reserve ratio would be 4% of 300, that is rupees 12. Now what is cash reserve ratio? Under the cash reserve ratio, banks have to keep aside certain amount of money as in the form of cash with the Reserve Bank of India. This is what is cash reserve ratio is. As far as the SLR, that is the statutory liquidity ratio, is concerned, so it is currently 19.5%. Now again, this ratio is 19.5% of NDTL, that is the net demand and time liability. If we calculate 19.5% of 300, then it would come out to be 58.5 rupees. So basically, if we say after keeping aside money for the cash reserve ratio and the statutory liquidity ratio, the net money that is left with the banks is 229.5 rupees. That is, this money they can lend out as loans. So this is the concept of ratios. Cash reserve ratio, basically that ratio on which no earning would be there of the RBI, of the banks, all the money would be kept aside as idle cash with the Reserve Bank of India. And if we talk about the statutory liquidity ratio, then it is a money that it is that portion of the NDTL, it is that portion of the money that is invested in the government securities, gold, liquid cash, or any other RBI approved security. So basically, the major difference between the cash reserve ratio and the statutory liquidity ratio is that in cash reserve ratio there is no earning of the bank, whereas in the statutory liquidity ratio there is some earning of the bank. Let us say that if under the statutory liquidity ratio banks invest some money in government securities, okay, now if they are investing some money in the government securities, then obviously government would be giving them interest payment. Or if they are investing in gold, then as the rate of the gold would increase, the banks would have some sort of earning. So this is the major difference between cash reserve ratio and the statutory liquidity ratio, that in cash reserve ratio there is no earning of the bank, whereas under the statutory liquidity ratio there is some earning of the bank. So these are the two ratios, and we also saw the concept of NDTL, that is the net demand and time liability. Coming to the next concept, we have Basel III norms. Now there is just one thing that is to be understood as far as the Basel III norms are concerned, and that is that if you are giving a loan worth 100 rupees, then you need to maintain a separate capital base, you need to maintain a separate capital of 10 rupees. It means that as far as the Basel III norms are concerned, you need to maintain a capital base of 10%. It means if you are giving out a loan of 100 rupees, then you need to keep aside 10%, that is 10 rupees in a separate basket. So now we have three kinds of baskets. One is the CRR, another is the SLR, and third is the Basel III norms. The CRR basket is 4%, then SLR basket is 19.5% depending upon the net demand and time liability, and this Basel III norms are the 10% of the loans that are being given out. So there is a difference between the three baskets. In CRR and in SLR, we depend upon the net demand and time liability, but in the Basel III norms, we depend upon the loans that are being given out. So as far as the Basel III norms are concerned, it is only just one statement. You must have heard of Basel III norms again and again and again in the news articles and in every magazine possible for the UPSC. Basel III norms is just a one-line concept, and that is you need to maintain a capital base of 10% and 10% of the loans that you are giving out. That is the concept of Basel III norms. Okay, this is completely different from CRR and from SLR. Now if we talk about the actual figures are something different, obviously. Okay, so currently let us just assume a crude figure that currently 5 lakh crore is our capital base, and we need to take it to 6.8 lakh crores. Okay, this is the capital base that we need to maintain under the Basel III norms. So we need to maintain 6.8 lakh crores capital base, and currently we have only 5 lakh crores. So as far as the Basel III norms are concerned, we need 1.8 lakh crore more to fill our capital base. Okay, so as far as the Basel III norms are concerned, we need additional 1.8 lakh crores. That is currently whatever the amount is there in our capital base, we are facing a shortfall of 1.8 lakh crores. So we need to fill this gap of 1.8 lakh crore by 31st March 2019. Now out of this 1.8 lakh crore, the shortfall of 1.8 lakh crore that we are facing, the government has promised to give 70,000 crores in 4 installments. In 2015 budget speech, Mr. Jaitley has announced that 70,000 crore would be given out of this 1.8 lakh crore, and that would be given in 4 installments starting from 2015 till 2019. And the remaining part, that is the remaining 1.1 lakh crore, would be raised by the banks depending upon their own profitability, shareholding, issuing of bonds. So that is the current scenario, that for example, if we have a capital base of 5 lakh crore, we need to go to 6.8 lakh crore. So in actual terms, we are facing a shortfall of 1.8 lakh crore to fill the gap. 70,000 crore would be provided by the government, and 1.1 lakh crore banks need to raise on their own. So this is the current situation in our country, and this is the actual figure. This is the right figure, that 1.8 lakh crore we need to raise to meet the Basel III norms. So these were the actual figures that we have seen now. Now we would consider the impact of non-performing assets on banks. That what is the impact of these non-performing assets on banks? Let us consider that there is a loan of 100 rupees. So obviously under the Basel III norms, 10% need to be maintained as capital base, and so we have a capital of 10 rupees. Fine. This is the current scenario, and just keep this example in mind till the end of this lesson, because I will be referring to this example again and again. Now let us just consider that there is an NPA of 5 rupees. Okay, we are in this particular portion, we are seeing the impact of NPAs on the banks. Okay, so let us say there is an NPA of 5 rupees. It means that this 5 rupee won't come back now, and banks have categorized this loan as a non-performing asset, and this 5 rupees is a dead 5 rupee and it won't come back now. Okay. What would happen is, since those 5 rupees won't come back, so the loan amount would get reduced from 100 to rupees 95, and the capital base would get reduced from 10 rupees to 5 rupees. Why? Let us see here. This is a bank, this is a corporate, and this is the individual who has deposited his money in banks. Let us say this individual deposited 5 rupees in bank, and this bank gave a loan of 5 rupees to this particular corporate. Now, this is the depositor, this person is the depositor, and these 5 rupees are the liability of this depositor on this particular bank. Okay. Now this corporate fails to return this 5 rupees back, so it turns into NPA. This is one scenario. Now, even though this has turned into an NPA, but then also banks need to return this 5 rupees back to this particular depositor, because he has deposited money in his account, and using that money banks gave loan to this corporate. This is NPA. Now banks need to give 5 rupees back to this person. So where would that money come from? That money would come from this particular capital base that has been maintained under the Basel III norms. So it is this money, this 10 rupees, that we would be using to return the money back to the depositors who have deposited their money in the bank. So this is how the chain is currently working. And so even though the loan got reduced by 5 rupees, the loan currently outstanding loan is 95 rupees, because that 5 rupee loan is now dead. The capital base would also get reduced from 10 rupees to 5 rupees, because it is using this capital base that we paid back the money to the depositor. So this is how this particular chain is working. So this is the current scenario. Now, how the NPAs are impacting the banks, let us look at that. So as per the Basel III norms, we need to maintain a capital base of 10%, right? 10% of the loans. Now, earlier, the loan was 100 rupees and the capital base was 10 rupees. So it is exactly 10%. That is totally fine. Now, the loan is 95 rupees. So the capital base should be 9.5 rupees. That is the 10% of 95. But the capital base is only 5 rupees. Okay, so it means that earlier the capital ratio was 10% when the loan was 100 rupees and the capital base was 10 rupees. So then the capital ratio of 10% was exactly maintained. There was no issue. But once there is an NPA, then banks need to give money to the depositors from this capital base. And as a result of the NPA, the capital base of the bank got eroded. And because of this erosion of the capital base, the deterioration of the capital base took place and the capital ratio is now being disturbed. Earlier it was 10%, but now it is much less than 10%, somewhere around 6% this is now. So basically we need to maintain a capital base of 9.5 rupees, but we have only 5 rupees. So as a result, we are not currently meeting the Basel III norms. So this is the impact of the non-performing assets, that our capital base gets deteriorated and our capital erosion takes place. And also, the stability of the banking system is impacted. So what is the scenario now? What we need to do? Current capital is 5 rupees. We need to maintain a capital base of 9.5 rupees. So we have a shortfall of this particular 4.5 rupees. To meet this shortfall of 4.5 rupees, either the government can provide money to the banks, to the public sector banks basically, where the government has majority shareholding, or banks may give out loans and earn profit so that this shortfall of 4.5 rupees can be met, or the private investors can buy the share of banks, or they can buy the bonds of banks so that this particular shortfall of 4.5 rupees can be met. So basically the current scenario is that we have 5 rupees in our capital base and we need to maintain the capital base at 9.5 rupees, and so we have a shortfall of 4.5 rupees. We need 4.5 rupees to meet the Basel III norms so that the 10% of the loan can be maintained as the capital base. So now we have seen that how the non-performing assets actually impact our capital base. The erosion of the capital base takes place, the financial stability is impacted, and it is because of this reason that NPAs are considered really threatening as far as the macroeconomic stability and the banking stability of the country is concerned. Now we would consider the case of disguised NPAs. So let us just consider the same example again. Loan is 100 rupees, capital is 10 rupees, NPA is 5 rupees. Now what game banks are now playing is that, you must be knowing that it is the responsibility of the bank to identify a particular asset. It is the responsibility of the bank whether to categorize a particular loan as NPA or not. It is totally upon the banks to identify that, right? Now what banks are doing is they are not recognizing these NPAs. Let us say that there is an NPA of 5 rupees now. So the banks are refusing to accept this NPA as 5 rupees. Why? Because if banks would accept this NPA as 5 rupees, then loan would become 95 rupees and the capital would become 5 rupees and the capital ratio of 10% would get disturbed. Because this is not 5 is not 10% of 95. So their capital ratio would get disturbed, and also they would not be able to meet the Basel III norms, and financial stability of the banking system would be jeopardized. So what they are doing is they are not identifying this loan as NPA so that the loan can be maintained at 100 rupees and the capital base, more importantly, can be maintained at 10 rupees, and so the capital ratio would remain at 10 rupees. So their funda is no NPA, no capital base erosion, no problem. Basically, they are actually treating themselves as blindfolded. They are not seeing the actual picture, and so basically what they are doing is they are preventing themselves from recognizing the NPAs, and as a result of that, the capital base erosion is not taking place. So I hope you must have understood this point, that how the recognition and the identification of NPAs is not taking place, because if this is the case, then capital base erosion would take place and the capital ratio of 10% would not be maintained. So we have seen two concepts till now. One is how NPAs are impacting the capital base and how capital erosion is taking place. Second, we have seen how banks are refusing to identify the non-performing assets. The next concept is capital infusion. So let us just consider the same example again. So now just consider the same example again. Loan 100 rupees, capital 10 rupees, NPA 5 rupees, not recognized. Okay, this is the scenario till now. Now let us say government says that we have a lot of revenue from the GST and from demonetization as well. We earned a lot of money. So government decides to infuse 20 rupees into the capital base of the bank. Okay, so the new capital base would be 30 rupees. What is the implication of that? Even though the loan is 100 rupees, the capital base is now 30 rupees, which means that the capital ratio that was supposed to be 10% is much more than that and is currently maintained at 30%. So capital ratio is much more than what is to be maintained. Capital base is much more than expected. So this is because of capital infusion, we saw that how our capital base got enhanced and our capital ratio is much more than the required limit of 10%. So now what would happen is the banks would recognize this NP of 5 rupees, because if they would recognize so, then loans left would be 95 rupees and capital would be 25 rupees. Then also the capital ratio would be at 26%. If we divide 25 by 95, we would get 26%. Okay. So then also, even after recognizing the NPAs, the capital ratio is maintained at 26%, which is much greater than 10% limit. So we saw that how, because of the capital infusion by the government, the banks are now easily recognizing their NPAs because the capital ratio is much greater than 10%. So this is one of the positive effects of capital infusion into the banks, that if their capital base is strong, then they can easily recognize and solve the NPA problems. Now, coming to the next scenario. Loan now is 95 rupees after recognizing the 5 rupees NPA, and the capital is 25 rupees. Okay. Now just understand this point that the loan giving capacity of the bank depends upon the capital base as well. That is, if the capital base is high, if this value is high, then banks can give more and more loans. Basically, currently the capital base is 25 rupees. It means that even though your current loan value stands at 95 rupees, but then also you can give out loans up to 250 rupees. If you are able to give loans up to 250 rupees, then also your capital base would be 25 rupees and you would have a capital ratio of 10%. That is perfectly in synchronization with the Basel 3 norms. So basically we see that if we have a greater capital base, if we have a deeper capital base, if we have more capital base, then we would be able to solve our NPA problems, because we would have margin, we would have scope to deal with the NPS, to recognize and solve NPS, and also we would have scope to give out more loans because we have a huge capital base. And so we saw two benefits of capital infusion. One is the recognition of NPS and resolution of NPS, and second is that we can give more and more loans, and as a result of that, now because of the capital infusion, we can lend up to 250 rupees, and we have currently given out only 95 rupees as loan. So we can give 155 rupees more as loans to different corporate sectors. More loans basically means more job creation, more productivity, more GDP, and more earning for the banks. So basically that would be good for the macroeconomic situation of the country. And so basically we saw that how capital infusion into the banks actually solves the twin problem of the NPA resolution as well as the growth problem. Till now we have seen smaller dots, and now it is time to connect all those dots. We would connect all the concepts that we have seen, and we would see the actual provisions that have been announced by the government of India as a part of the recapitalization plan of the public sector banks. So as far as the capital infusion by the government of India is concerned, so they have decided that they would be infusing 2.11 lakh crore, that is 2,11,000 crores in the public sector banks over a period of 2 years. As we have seen in the previous slide, that if we need to do the capital infusion, then that can be done by the banks through their own profits, or the government or the private sector can do that. Private sector can buy the shares of the banks, or the government can infuse capital. So we had seen in the previous slide 3 mechanisms by which the capital infusion into the public sector banks can take place, right? And so under this particular recapitalization plan, the government has decided that this recapitalization would take place in 75:25 ratio. That is, 75% of this 2.11 lakh crore would be provided by the government, and the remaining 25% would be provided by the private sector. And also this plan would ensure that the majority shareholding of the government in the public sector banks is maintained. So these are the broad facts regarding the recapitalization scheme of the government of India. And now we would be looking into the greater detail each of these plans. So basically the government of India is now taking to a three-pronged attack upon the capital base erosion of the banks because of the rising NPAs. We have seen that because of the rising NPAs, there is a growing problem of capital base erosion, because of which banks are not able to lend out more money to the borrowers. So the 3 tools that have been suggested by the government of India to actually deal with this problem are: first is the recapitalization bond. The recapitalization bonds worth 1.35 lakh crores would be issued by the government of India. This is the most significant chunk of pie, and this is also the most important tool, having widespread implications that we would be looking in the future slides. Second is the budgetary allocation of 18,000 crores. This is not 18 lakh crore. I'm really sorry for this mistake. This is 18,000 crores. Okay. Also, banks would be raising money through private sector by issuing shares to the private sector, and they would be raising somewhere around 58,000 crores. Again, this is 58,000 crore, not lakh crore. So 18,000 crore from budgetary allocation, 58,000 crores by issuing shares to the private sector, and also the recapitalization bonds worth 1.35 lakh crores would be issued by the government. And so it is this 3-pronged strategy that would be used by the government of India to recapitalize banks, to infuse more capital into the Indian public sector banks. We would look at all the 3 tools one by one. So first, let us look at the most important tool, that is the recapitalization bonds. So as far as these recapitalization bonds are concerned, so let us just consider that you are an investor, you are a non-banking financial company, okay, and I am the government. I gave you bonds of 10 years maturity. You gave me money in return of those bonds, right? I would now take that money and give it to SBI, Punjab National Bank, UCO Bank, to all the public sector banks, right? As I gave them money, they would increase my shareholding in their company. As a result of that, the shareholding of the general public would get reduced and my shareholding in their bank would get increased. As a result, whenever they would issue dividends, they would share the profit, I would get greater profits. So, by the means of this recapitalization bonds worth 1.35 lakh crores, I would be infusing more capital into the public sector banks. But one of the points that you should keep in mind here is, since I am raising that money from you, I'm issuing the securities for 10 years to you, so I would be liable to pay interest to you, as well as after 10 years I would need to pay you the principal amount. So I need to pay you the interest as well as the principal amount. Now I would be paying the interest on that particular loan, that particular, the bonds that I have issued, and also I would raise money, give it to banks, and as a result my shareholding would increase and I would maintain my majority shareholding. So this is what the recapitalization bonds would do. Coming to the implications, what would be the impact of these bonds on the macroeconomic situation? The first impact that they would have is the crowding out of private investors. So the implication is crowding out of private investors. Let us say that Mr. Jaitley and Mukesh Ambani, two people come to you. You have spare money. You are the non-banking financial company, and now you need to give loan. You have limited money. Okay, you have, let us say, 100 rupees only. Mukesh Ambani also wants 100 rupees, and Arun Jaitley also wants 100 rupees. Now you can give that money only to one of the person. So through any means, persuasions and all that, Arun Jaitley convinced you to give him 100 rupees. Now you gave that 100 rupee note to Arun Jaitley. He would give you bonds, and then that 100 rupee would be infused into the public sector banks, and the government shareholding in the banks would increase. But Mukesh Ambani wanted to launch another branch of Geo, so it is because of this reason he was, asking you for 100 rupees. But now all the money from the market has been given to the government for the recapitalization scheme. So Mukesh Ambani won't be able to find new loans, new lenders, and as a result, his business expansion would come to a standstill. So this is what is known as the crowding out of private investors. That is, they would be crowded out. Let us just consider that there is a room, the deal failed, and so Mukesh Ambani went out without taking any money. So crowding out basically means that private investors won't get money, and as a result they won't be able to go in for business expansion. But the government has a counter argument for this crowding out impact, and that is that once the capital infusion is done, once 20 rupees are given additionally to banks, that is, the capital base of the banks become rupees 30. Just consider the example that we were considering, right? Once the capital base becomes 30, so banks would be able to recognize the 5 rupee NPA, 5 rupee NPA that we had considered, and also they would be able to give additional 155 rupees loan that we had given in that particular example. So because of the additional capital infusion, banks would be able to deal with the NPA problem, as well as they would be able to give out more 155 rupees loan. So the government says once the health of the banks would improve, they would give out more loans to the private sector now. That is, additional 155 rupees would be given to the private sector. And as a result, this increased credit growth, this increase in the loans would balance out the crowding out impact. So government says that even though this crowding out impact would be a short-term phenomena, but in the long run, the corporates, the people would get more loans from the bank, and that would be beneficial for them in the long run. So this is the one concept that we have seen, one implication that we have seen. The second implication is the fiscal deficit. As I already told you that since I am giving you bonds, you are giving me money, and so I would be paying interest to you, and after 10 years, after the bonds get matured, I would pay you the principal amount. So because of that, the fiscal deficit would increase. So that interest liability that I am now taking upon myself, as a result of that, my fiscal deficit targets may get disturbed. This 3.2% of the fiscal deficit target may get disturbed, and as a result, I may not be able to meet the fiscal deficit targets. But government has a counter argument for this as well. So they say that earlier in the ancient in the previous times, in a decade earlier or so, most of the fiscal deficit was because of the subsidies. Government was giving different subsidies, different cash schemes to the poor people. Let us just consider that the government gave came up with a scheme that whosoever is below the poverty line, we would be giving 500 rupees cash to them. Now, since this is an expenditure of the government, so obviously the fiscal deficit of the government would increase, and so because of this 500 rupees, the inflation would also increase. Because when the government is giving 500 rupees to all those who are below poverty line, then demand would increase, and as a result, the inflation would also increase. So the government says that we are not giving any such subsidy, we are only doing this for the good health of the banks, and also the interest liability that we are accruing would be given to the non-banking financial company. That is, it would be given to you because you are the non-banking financial company, and it won't be given as cash, or it won't be given as subsidy to any poor people, LPG subsidy, urea subsidy. So this is not a subsidy burden, so it is non-inflation causing. That is, because of this liability, this rise in the fiscal deficit, inflation would not be a concern. So this is the counter argument that has been given by the government. Now, as far as the way forward of these bonds is concerned, so let us just consider that as a part of those 10-year bonds, I would be giving 100 rupees interest to you. Also, because I have infused money in the banks, my shareholding has increased, and so I would be getting greater dividend now. Now, due to this capital infusion, now let us say banks have performed really well and their profitability also increased, and now they are earning a lot of profit and their dividend is very high. Let us say they are giving you a dividend of 200 rupees. So basically the interest liability that you are giving would be less than the dividend, and as a result the government would be earning net 100 rupees. So basically, if the banks perform well, then the fear that we had regarding the increased fiscal deficit, that would be shredded away, that would be done away with, because if dividends are more than interest payment, then ultimately government would be earning some profit. That would be useful, and that would be a win-win situation. But if the banks didn't perform well, if the banks are not performing up to the mark, then dividend would remain low. And let us say that the interest liability is 100 rupees and the dividend that you are getting is 50 rupees. Then your fiscal deficit would increase, and as a result this capital infusion would turn out to be a failed attempt, because even after capital infusion, banks would not be able to perform in a very good manner, and as a result their profitability and their dividend would remain low. So these are some of the macroeconomic considerations, implications that we have seen. Another point that I would like to cover here is the features of bonds. As far as the features of these bonds are concerned, whether they are tradable in the security markets or not, whether they can be used as collateral for loans or not, so these features are not clear, and they would become clear only in due course of time. For example, you have taken my securities. I am the government, you are the non-banking financial company. You are giving me money. Now let us say you need money for some purpose. So it is unclear whether you would be able to keep those papers as collateral to loan or not, whether you would be able to sell them in the secondary capital market or not. So these are some of the features that are unclear, and as they would become clear, I would update you with time. So we have seen first tool that the government is using out of the three tools, that is the recapitalization bonds. Now we would be looking at the selling of stakes to raise 58,000 crores. Now, as far as the selling of stake is concerned, so as per the plan of the government aims to sell the shares of the public sector banks in the share market worth 58,000 crores. That is a follow-on public offer, that is the FPO would take place, and the shares worth 58,000 crores would be sold in the capital market. But there is one issue with this particular solution. There is one issue with this particular tool, and that is currently the shares of the public sector banks are trading at discount to the face value because of the rising NPAs, because of the reducing macroeconomic stability, because of the reducing profits. These banks are not giving out much dividends, and as a result of that, the demand for shares of these particular banks is actually reducing, and because of which they are trading to discount to the face value. And let us just consider an example. Had State Bank of India been profitable, it would have been a stable bank, then its share would have been trading at 100 rupees. Let us just consider an example. And also let us just consider that State Bank of India issued 10 shares. So as a result of that, through 10 shares, State Bank of India would be able to raise 1000 rupees. Fine. But currently, because of the rising NPAs and all that story that we read just now, the shares of SBI are trading at 20 rupees, let us say, and they are again issuing 10 shares. So they would only be able to raise 200 rupees by this share issue. So basically my point here is, because of the rising NPAs and because of the lack of profitability in the public sector banks, the State Bank of India won't be able to realize the full potential of its share issue. It would have been able to raise 1000 rupees, but because of the current circumstances, it would raise only 200 rupees. So this is one challenge that can be there in the way of the second tool. The third tool is infusion of 18,000 crore rupees by government through the budgetary allocations. In this particular infusion scheme, the government would be infusing 18,000 crores into the public sector banks. Where did the government get that money from? So that is basically the money that the government has raised as a part of the revenue receipts, and so that is basically the taxpayers' money that the government would be spending on capital infusion of the public sector banks. So there is a moral hazard that arises. Let us say Vijay Mallya took loan, he used up the money, and he fled to London. Now what is happening is, because of people like Vijay Mallya, the banks are facing the issue of capital erosion, capital base erosion, and now the government is using the taxpayers' money to actually infuse more capital to strengthen the capital base of the public sector banks. So if we see the indirect chain, then it means that the money that was used by Vijay Mallya is now being compensated by taking more revenue from the people. That is, it is the normal taxpayers like you and me who are ultimately made to pay for the fraud and the misdeeds of people, of such people who are not giving the loans back. So there is a moral hazard that, corporate people would keep on doing scams, and they would be they would become more and more willful defaulters. They would not pay back the loan, and it is us, the common people, the taxpayers, who would be made to bear the brunt of this particular non-performing assets. So there are some moral hazards that are associated with this problem. So infusion of 18,000 crores has two dimensions. One is the ethical dimension and another is the moral dimension. If we see the one is the economic dimension and another is the moral dimension. If we see the economic dimension, then from the economic dimension point of view, if we infuse 20 rupees, then banks would be able to take up the issue of non-performing assets, and also they would be giving 155 rupees more loans. Just consider that example that we have considered. And the moral dimension is that even though people like Vijay Mallya are running away as willful defaulters, they are taking up and using up all the money, the general public is being made to pay. Had that 18,000 crores that the government would now be infusing used for education, health and infrastructure development, that would have given some benefit to the citizens of the country. So this is the moral hazard here. Now we have seen all the three tools that are associated with the recapitalization of the Indian public sector banks. Now we would see the way forward and what are the steps that can be taken so that the rise of NPAs can be prevented in future. Once the capital infusion is done, once the banks using a deeper capital base solves the problem of NPAs and gives out more loans, then after that there should be no more NPAs. We would see some of the steps in that regard now. So the first solution is that banks should recognize NPAs. Now because they have a larger capital base, so they should recognize the NPA problem, they should auction the assets. So basically once they have recognized the NPAs, they should just take the collateral from the defaulters and should auction it. Be it a highway project, hydropower project, or be it any other collateral, coal field, coal mine, whatever be the project is. If anyone is not able to return back the loans and the loan has been declared as NPA, then the government should seize the collateral and should proceed forward either with the means of the asset reconstruction company or using the Insolvency and Bankruptcy Code 2016. So the main point here is that till now the banks were shying away from recognizing the non-performing assets because that would have eroded their capital base. We have seen this thing already in the previous slides. Okay, so now banks should recognize more and more NPAs so that more and more solutions can be found out and NPA problem can be tackled with. Second is, as the capital base of the banks would increase, they should indulge in better lending, more lending. That 155 rupees should be lended more. Just consider that example that we have seen earlier. So that would lead to greater lending to the micro, small and medium enterprises, greater job creation, more demand, more growth in the economy. So that is a very good solution that is being proposed by the government, that once the capital infusion is done, the twin problems of the NPAs as well as the low credit growth in the economy would be solved, and the credit growth in the economy would increase because of the better lending, and the NPA problem can be dealt with. We have seen one moral hazard of this scheme. The another moral hazard would be that other corporates may be motivated to become willful defaulters. That, Vijay Mallya example or any other example, that look, even if we keep on doing fraud, we keep on eating up the money, then also the government would use the taxpayers' money to dole out the banks, to rescue the banks, to bail out the banks. So that this actually sets a wrong precedent for the corporates, and so strict action should be enacted so that corporates should not indulge in any sort of the willful defaulting or any sort of non-performing assets. This is one moral hazard. Another is, the banks may feel more complacent and more lax on their part, that look, even if we are not doing well on the NPA part, we are not performing good, but then also the government would help us by using the taxpayers' money and they would keep on infusing more and more capital. One of the points that should be kept here in mind is that since most of the public sector banks have like all the public sector banks have majority government shareholding, more than 50%. So these public sector banks come under the supervision of CBI as well as the Central Vigilance Commission. That is, if the management of these banks take any wrong action, then investigation by CBI or CVC can be initiated against the staff of these banks, the public sector banks I'm talking about. So it is the fear of CBI and CVC that prevents the management of the public sector banks to take harsh decisions, to take bold decisions to recover the non-performing assets. It is because of the lack of these bold and harsh decisions that the banks are not able to, that the public sector banks are not being able to transform them into the profitable banks. So one of the solutions that can be provided here is that the government control over these banks should be reduced, and basically the government shareholding should be reduced. These banks should be made more and more private so that they can go in for harsh decisions, and the fear of CBI and Central Vigilance Commission can be reduced. So this is it from this lesson. I hope all the contours and nuances regarding the recapitalization of the public sector banks in India are clear to you. If you have any doubt, any opinion, you can mention it in the comment section, and you can also follow me on Facebook and Quora. Thank you very much.